I've gotten a lot of requests from the high yield dividend warriors to make a video about the new Get Rich Ice Cream Flavor ETF of the week, and that is WPAY, the Weekly Pay Universe ETF by Roundhill. So I have to give the people what they want. I have to talk about WPAY. So what if you could get paid weekly from a single investment, offering exposure to the hottest tech stocks out there? So that's the promise that Roundhill's Weekly Pay Universe ETF, or WPAY, is giving us. Now, its core position is an income-focused ETF that aims to provide high weekly distributions. It's designed for those who want aggressive income right now, who are very bullish on the US tech sector, particularly the Mag 7 stocks. Though there are some warnings, guys. Shocker. Something with a distribution rate of 84% might have some big risks. The fund's own prospectus warns it's not a suitable investment for all investors. So we're going to break down the mechanics of this fund, because if you don't understand how this fund works, you could potentially lose a significant portion of your principal. And if you do understand how it works, well, then maybe you might actually make a lot of money. So WPAY is not that old. In fact, it was only launched in September of 2025. But you know those high yield dividend warriors, if they see a shiny new fund, it's only been out for 6 weeks, they will throw their entire life savings at it just because it's been paying a few fat dividends so far. A lot of people have been drawn into WPAY because, like its name suggests, it gives out weekly distributions. Now, I have debunked how getting paid dividends weekly or monthly makes next to no difference from a cow pounding perspective compared to quarterly stocks or ETFs. In fact, a good investor could care less about how often a ETF or stock pays dividends. That is one of the last things they should be worried about. They should be worried about the company fundamentals, what criteria the ETF has to function in the future. All of those mean a lot more for an ETF success than worrying about how frequently they pay dividends. Now, that is not my opinion. If you're going to hate on me for that, that means you just hate facts and logic, and that means you disagree with mathematics. Now, WPAY is not a traditional ETF. It's a fund of funds, meaning it owns other individual ETFs. In this case, it's all the Roundhill weekly ones. We're talking about the ones that cover Apple, Berkshire Hathaway, Google, Microsoft, Amazon, even the beloved MicroStrategy or Strategy, whatever Ponzi scheme type name they want to name themselves these days. And you can see it's all weighted about equally across the different ETFs, around 6.6% for every holding it owns. Now, unlike some complex ETFs that use synthetic exposure, WPAY actually owns the shares of the underlying Roundhill weekly funds. Now, regarding the equal weighted and tech concentration, the fund actually has a passive strategy. It just rebalances monthly to equal weight all the eligible single stock weekly pay ETFs. You could see how this can be a little bit absurd. This means a monster, gigantic company like Microsoft, which has trillions of dollars in market cap, is weighted the same exact as a company like MicroStrategy, which is considerably smaller. And if you knew anything about their business models, you know that one is actually a very reputable company that actually makes goods and services that people use every single day, while the other one is just simply buying Bitcoin. So already, I think a lot of people are going to be mad at this. It's also heavily concentrated in the tech sector. So you might have exposure to different holdings, but this is overwhelmingly in the tech sector. So you're probably not as diversified as you might think. By owning WPAY, it's a massive bet on the sustained dominance of the Mag 7 and other tech powerhouses. Now, that's not necessarily a bad thing if you are somebody that's very bullish in this space. All right, so now we need to talk about the underlying strategy of WPAY. It's to achieve its unique combination of high income and leveraged equity exposure. So each single stock weekly pay fund uses a very sophisticated, actively managed strategy. Now, if you know anything about the stock market, typically those that are actively managed actually do worse than those that are passively managed funds. I know it sounds counterintuitive, but that's just the way the stock market works. Now, what WPAY is doing is called total return swaps, or TRS. So that is the core mechanic for this fund. They're using total return swaps. So what is a TRS? Well, think of it kind of like a contract where the fund pays a counterparty. This could be a large bank, a fee, like a fixed rate or spread, and in exchange, the bank pays the fund the total return of the underlying stock. So this could be capital appreciation and dividends. The fund is essentially renting the performance of the stock without physically holding the stock itself. Now, this does come with some advantages. Now, you know, a lot of income funds in this space, they're doing covered calls. That's the traditional income fund. They often write covered calls to generate a premium, but that caps the upside of the stock. That means you miss out on massive rallies. And that's where WPAY might get a slight edge. By using total return swaps, the underlying funds can avoid selling covered calls and maintain the potential for uncapped upside on the stock's appreciation. Now, did I mention that they're actually using leverage? Well, the fund actually layers on leverage, aiming for a 1.2 weekly leverage target. This means they have 120% exposure to the underlying stock. Now, leverage comes as a double-edged sword. Yes, when the stock market is doing great, that leverage looks beautiful. It's going to amplify those returns. If the underlying stock gains 10% in a week, weekly pay is going to get around a 12% gain. But in a down market, it works the same way. It does that cow pounding, guys. If the underlying stock drops 10% in a week, weekly pay fund is going to drop about 12%. The losses get magnified. And of course, it wouldn't be a good Citizen of the Year video if I didn't talk about most dreaded words, NAV erosion. Now, there is a big risk here of volatility drag and frequent cow pounding. You see the single stock funds reset their 1.2 times leverage target every single week. This is crucial. This means that frequent resets work the same going down as they do going up. This again magnifies those losses. Now, the danger of a sideways market is very real with a fund like this. In volatile sideways markets, the constant rebalancing and cow pounding of gains and losses can lead to NAV erosion. This is a common and severe risk for any leveraged fund held for an extended period of time. Now, another risk is the high distribution rate. In this case, it's really a return on capital. Now, WPAY hasn't been around that long. It's going to be kind of hard to estimate how high this dividend yield will really be. What you see here on Seeking Alpha is just not accurate. It's only taking the last 6 weeks that it's been out, and we know it's going to be paying out a lot more in dividends. I anticipate this might be closer to 50 to 80% distribution rate. Now, you'll notice they intentionally use the word distribution rate here. That's a lot different than dividend rate. Now, remember, weekly distributions, they're a key feature of WPAY, but they are never guaranteed, and the amount is variable based on an algorithm that Roundhill has incorporating stock returns and volatility. Now, the distribution can and likely will include a significant portion of ROC, or return on capital. Now, return on capital is essentially getting your own money back. It is not free money or profit necessarily. Now, there is a trade-off, tax versus the principal. Return on capital can have short-term tax benefits. This means you can defer taxes by reducing your cost basis until you sell. But the catch is that the reliance on ROC distributions leads to massive NAV erosion over time. Think about it this way. A cash register can only pay you so long without needing real profits inserted into it. The high weekly distribution rate, it might seem very high right now, but it could over time eat away at the principal, and that means the dividends can go down. Think about it this way, guys. Remember when Tesla and Alti and Misty came out. The dividends were super fat at the start. Everybody thought this would be the next get-rich-quick scheme. People were planning on quitting their jobs, investing their life savings into these yield max products. And guess what happened? A lot of them lost money during one of the biggest bull runs in history. Now, why did this happen? Because the distributions were too fat. Over time, NAV erosion continued to happen, and those distributions continued to go down. And those people had to go straight back into work because those dividends didn't last for the rest of their life. For the rest of their life! That's a very expensive mistake to make, and I don't want any of you guys to continue to make these get-rich ice cream flavor mistakes going forward. Now, we do need to talk about the expense ratio. Right now, it is 1.28%, but Roundhill is super nice and is actually waiving that through September of 2026. So it is essentially being managed for free. Now, why would Roundhill do this? They're essentially trying to get people into the door. They're trying to entice new investors. So props to them for doing that. But at the end of the day, guys, if they are going to have a 1.28% basis points expense ratio, that is pretty expensive. Though I do understand it is actively managed. At the end of the day, that is coming out of your pocket, so that is something that you need to keep in mind. All right, so who is WPAY really for? And again, the prospectus actually gives some big warnings that reiterate that this fund is not diversified. That is Roundhill's words, not mine, though I do completely agree with that. And it is not suitable for all investors. It's only for knowledgeable investors who understand the fund's mechanisms and manage their own portfolios. There are a lot of downsides to this fund. There's massive downside risk. A single huge down day or week in the tech sector could cause out of proportion losses due to the concentration and the leverage that this fund uses. As I mentioned before, there could be potential for massive NAV erosion. This is the combination of leverage and volatility decay and the potential for distributions to be mostly rock, which can destroy the fund's long-term value. And then, of course, there's the absurd allocation. There is so much of this fund that is just dedicated to the Mag 7 and tech giants. Honestly, if you're somebody that likes Roundhill, you'd probably be better off just buying the individual weekly pay ETFs that you personally like and have strong convictions in. Or you could just do what I do and buy those stocks individually. But hey, my investing strategies might be different than yours. Now, there is a case for WPAY. It exists for the aggressive income investor who is extremely bullish on the overall tech sector and wants weekly payments without having to actively pick the individual single stock ETFs. It is a highly engineered one-click wrapper for this high-risk strategy. If you really wanted my personal take, this is really not a sleep well at night type of ETF for typical long-term investing portfolios. Investors have to be really comfortable with the possibility of principal erosion for the sake of aggressive weekly cash flow. If one were to invest in Roundhill, I really would encourage them to read the actual prospectus before investing even a single dollar. Now, I know many of you clicked on this video because you wanted me to just say positive things about WPAY. After all, I've been getting so many comments about it. Now, I could have taken the easy way out, just spewed a bunch of nonsense that you wanted to hear, done very well in the algorithm, but I just wanted to show you guys one thing. Remember who was making videos all the way back then about Misty, telling you, warning you that this fund was not going to get you a 200% yield every year. Were all those YouTubers who made pro Misty videos every single day, do you really think they had your best interest in heart? Or were they just milking you for the ad revenue? Or how about Alti, guys?
Oh man, I thought they stopped the NAV erosion. I thought they were doing the hedge fund strategies.
Yeah, I remember those days. Yeah, I mean, if you really think WPAY and Roundhill has your best interest in heart, please go invest in them. Remember, if you want full access to my $300,000 plus portfolio that has some amazing income ETFs that I actually personally invest in and has been beating the market for the past 3 years, come check out my Patreon and join the Discord. It's a great way to chat with other like-minded investors, and I'll catch you on the next one.
Here's the reality. You're going to be poor for the rest of your life. For the rest of your life.